So welcome back to Freightways Today. It is Sonar update. Julie, what are we looking at right here? It looks like volumes are on deck.
Yeah, so I thought we would go ahead and compare. Volumes are really leveling out, and you can see that this year that we had a little bit of a hike, and then they began to fall.
It was a lot. If you're especially trying to find capacity, it was a hike.
And then now we're seeing them really level out and stay closer to 2023. Yeah, we lost.
So let's just talk about this. This is 2035, which is the year over year. This would be 24 and 23.
Yep.
So really, a couple of years you're looking at really some slowdown that happens typically in that July-August period. You do see it drop. It dropped again this year in July, like normal. It's normal seasonality.
Very typical seasonality.
I think there's been some concern about whether this slowdown that we've seen this year is something more concerning, but this follows a very seasonal pattern. You can see it here. Now, maybe the significant increase that we saw was abnormal to seasonality, and that's what drove some bias that I including us, thought this would continue. It didn't continue. We saw it drop, sort of reset back, but still above last year's tender volume. And look, what's nice about this is that this data, if you look at seasonal, predicts it even in the softest year. If we go back to 2023, you could see that basically even in the softest of years, we do see increases going into Labor Day. And this is right at the period where Labor Day starts to really be top of mind. This year is a later Labor Day, which is probably why it's not started early, like it's a week later than normal, or has been the last couple of years. So we're going to start to see that pick up, really headed in, and this big drop that you see is Labor Day.
Yep, and we will, and then coming out of Labor Day is when we'll
see a big surge. You see it after, by the way, you see this right after Memorial Day as well.
Yes.
A significant surge, pops, just a lot of leftover orders.
Yeah, this was coming out of Labor Day.
Yeah, I do think it's interesting.
Memorial Day.
Looking at how significant the drop was back in 2000 and like last year versus this year. By the way, this is a data anomaly. It was a data feed problem. We have a rule of not overriding old data, so that is an anomaly that you should just completely ignore in 2023. It was a data anomaly, been fixed, but really what we're looking at here is the fact that last year we saw this significant trough during peak. October was weak. We saw it, as we've covered extensively. November was when the freight recession feels like everyone was sort of declaring it over, the Great Freight Recession. And that's when the market recovered. I think this year what we're going to see is much more like we saw back in 2024, stable year. And look, I think because of the things that we've covered extensively is that this peak season probably started earlier, like a lot of freight moving by intermodal, imports came in earlier than we expect. You may not see the big significant surge of freight headed into that October, November season. So it may be more muted than it has been and maybe more disappointing, more stable, which frankly, for motor carriers, except if you're operating strictly in the spot market, is better because you have more time to plan.
Yes. So similar story, tender rejections.
They're 2.5%.
Beginning to level out, right? Still obviously significantly higher than prior years, but beginning to level out. And so I wanted to look a little bit further into that and think about tender rejections, and kind of found an interesting, as we've talked about tender rejections, there has been mode shift to intermodal.
Yep.
So you can see this is outbound tender container volume. This is domestic intermodal volume, significantly higher than prior years.
And we've covered the intermodal rail, and now domestic has been the big winner, but intermodal rail has had its best year on record.
So much mode conversion.
It certainly it continues to increase, but one of the interesting things that we've covered is that a lot of the rail activities on the eastern half of the United States, not just the west. So it's not just the transcontinental freight. A lot of it is in the eastern half of the United States, benefiting from NS and CSX, who've been the big winners. And they're winning a lot of share versus truck because of that 34% discount that intermodal carries versus truck.
That's right. So I wanted to look a little further into average length of haul and how that relates to tender rejections and how that also relates to intermodal volumes, right? So this is again the seasonality of the prior 3 years, blue being this year. And overall length of haul has fallen significantly down to 463 miles. So you can see that we're way down here at this point. The reason that speaks to tender rejections, what we're seeing in the overall market, is that short length of haul freight tends to be accepted. That's generally contracted, it's highly repeatable, using the same carrier, versus that longer length of haul freight tends to have a higher tender rejection average, especially when you get above 800 miles. So, and you can see that in this chart, that the blue line is average length of haul, the yellow is average tender rejections, and they really move in tandem with each other. I mean, you can, there's some times when they tend
to diverge,
but they diverge. Yeah. But then as we have gotten into this year, February of this year moving forward, they really have moved pretty closely in line with each other, which makes a lot of sense of why we've also seen that sort of stabilization in tender rejections and them come back down to a more normal place around that 13.5%.
I think is interesting is that one of the things that I think may not be as obvious is that intermodal is taking on longer lengths of haul. With that, the savings are gained so much higher. We didn't plan on this, but yes, that's exactly it, right? Is that intermodal with 34% discounts?
Yep, this is length of haul in blue. This is tender rejections in yellow.
Yep.
And then this is domestic intermodal rail volume in gray.
Look at rail volume, length of haul down. So we're seeing shorter truck routes, because if you're tight on capacity, you can put it on the rail. Plus, when you're dealing with a 34% discount, you want that going over as long of a length of haul as possible. Rail benefits from that, particularly that rail fuel surcharge, which is cheaper than truck fuel surcharges.
And when freight is readily available for carriers, they're making that decision. Do I want to be under a load for a whole week? Or do I want to be able to get in more loads per truck per week at a higher rate per mile at that lower length of haul?
And I think shippers are also thinking differently about their routing guides than they have been. They're taking advantage of intermodal. We talked about the fact that this is not an overnight decision. You know, we saw fuel prices really start to pick up in February leading up to the war. We had the war in March, and really what we have seen since then is just continued increase in the crack spread that John Kingston loves to talk about. Is basically diesel prices. The spread is at all-time record highs between what oil would suggest versus diesel. And if you've seen the attacks, I know that we started talking about this. You started to really see these videos on social media, is that refiners are being blown up in Russia. And that is putting an enormous amount of pressure on diesel prices. I don't see that stopping, but there was an interesting post this weekend. They have built this cage around the airport in Dubai, these giant cages, which are collecting drones to prevent basically a drone from attacking the fuel island that's out there.
I saw that, and it was insane and really smart. Okay, so this is imports. Imports are ticking up, but I was going through these because I wanted to actually get to fuel since you brought it up. Spot market conditions. But yes, this is the actual DTS, diesel truck stop, actual price per gallon. And you can see that, you know, obviously we're up almost as high as when the conflict sort of started, and prices went up pretty quickly at that point. So we will continue to watch this as well.
There is no suggestion. In fact, the Trump administration has continued to, last week, talked about this was the tightest set of economic embargo, I think in history was the description they used. But basically a massive set of sanctions that they're going against the Iranian regime. Look, you got to give the Iranian regime a little credit for just saying, hey, we're not going to do anything. And they can hold out for a long time, or I believe they can hold out for a long time. So I don't know if the pressure actually makes a difference. I mean, I think we all thought the war would be one and done. At least I did. I don't know that everyone subscribed to that, but that's clearly not the case. The Iranian regime is holding out, and I don't know that this gets resolved anytime soon. But I think the more interesting side of the story is what's happening in Russia, is that a lot of the diesel concerns that we've heard from multiple guests on FreightWaves today is related to the Russian refinery activity, not what's happening in the Middle East.
That's right.
It's the diesel products, and you see these long lines, you can see these videos in Russia where it's just line after line taking hours to get fuel. And diesel is, you know, certainly being impacted by the lack of refinery capacity. And look, the Ukrainians are, you know, if anything, they're ruthless when it comes to taking out Russian infrastructure. And energy is the primary cash cow of the Russian Empire. So if you want to destroy the Russian economy, which Ukraine is definitely trying to do, you take out the energy infrastructure, which they are, that's part of their goal. So I don't think we're going to see a lot of relief. And I've been wrong about this. A month ago, Matt Leffler brought it up. I think he was talking specifically about Hormuz. I think Russia's off so many people's radar because I think Americans have a tendency to drown out conflicts
Well,
that
it's been
don't
going
involve
on,
us.
well, and it's been going on so
It's
long.
been going on
People
since
just
2022.
get,
We're over 4.5 years into this, and it just feels like a little bit of a stalemate if you sort of take the news. But the Ukrainians are continuing to just take drones, civilian drones, and attack infrastructure. And so I don't get the sense that this is going to resolve itself anytime soon. And I think the pressure on civilian infrastructure and supply chains is going to be more and more significant. It's going to put more pressure on that diesel price.
I agree. I think the only other thing that we wanted to talk about was that you and I have this continued conversation and debate sometimes with others that fuel cost is not always going to be reflected in spot rates. So this is
But they're
comparing.
diverging. Like
This
they're
is
two different
comparing
data points.
NTI is spot.
Yep.
This is DTS, diesel fuel price. And I
Who
think a
was
lot
it
of the
that we
things,
had a guest that was talking about this last week.
and that the cost, that rates go up when the cost of fuel goes up and they come down, but they
diverge.
just don't. They are based on supply and demand and what the market will bear at the moment.
There's a clearing price in freight that's set by supply and demand. And then it was at the Hall of Fame, by the way. I just remembered it. It was
Overdrive.
Yes, Overdrive. The VP of Overdrive, Director of Business Development, talked about this, is how they're diverged, which is exactly what the data says. You see this fuel price increase. Now, one is diesel price per gallon and one is price per mile.
Right.
But the important thing isn't the actual numbers, it's the direction of the charts.
Right.
What you've seen this year is that, yes, diesel moved up, took a bit for spot rates to move up with it. If you look at it, much greater move. This moved up, but then we saw some resolution.
Fell.
And
Right.
look, I think this is the telling answer, is that we've seen diesel since early July continue to go up, and we've seen spot rates go down. Proof that there is a disconnection between the two data points. Now, what's interesting about it is that this is retail diesel, as we've talked about in the show. A very small percent of motor carriers are paying retail prices for diesel. So it isn't, but the fuel surcharge is in that number. So shippers are getting hit from higher diesel prices.
Yep. Yeah, I just thought this was an interesting point to ensure that all of our viewers are remembering that this is really about what the market will bear and available capacity.
Freight rates are not the
about
same
cost.
thing as diesel price.
Yep, exactly.